Restream is live. All right. Oh, look at that new logo. Isn't that nice? All right. There, so. Whoa. All right. Okay. Thanks everybody for coming out to ETHVAN here at Decontrol every Thursday. Some of you new folks here today, thanks for coming in. Appreciate it. Yeah, we've been kind of cruising around here since like 2013. And unfortunately, we are going to be closing our doors very soon due to some construction that is taking place in this building. So we are actively looking towards a new space, and we'll be probably continuing doing like we'll still have like community activations and whatnot throughout, yeah, in the interim, call it. But we still have a few more weeks yet, so we're still trucking on and plan to keep it as vibrant as we can. So, yeah. See, we've also got an ETH Global event happening soon too, which is. Do you want to take a mic and give us a little update on that, please and thanks?
All right. We are organizing a monthly happy hour. This is going to happen at the Global Relay venue, kind of in Gastown. We did it once in December, great success. Doing the next one in February 5th. February 5th. Food, drinks catered. Just come by, very casual hangout, mingle, network. The event's on Luma. You can check our socials if you want to find the link there. Hopefully I'll see you there. Yeah. I can give you a breakdancing spot. Yes.
Okay. Sweet. So stick around for that, and then I don't know what else other events have we got kind of planned or head at. This thing is ringing really bad. I'll just bring it up here. Or I might take another mic here in a second, but. Yeah, as far as other things, yeah, we've got like poetry nights here on Mondays. That's still taking place. I think it's still happening. And then Saturday or Tuesdays. Are you still doing jam nights every once in a while?
Jam on Tuesdays.
Basement jams Tuesday.
Come by on Tuesday.
So, yeah, lots of cool things happening. And if you guys haven't tried the Pepsi in the back, there's like the soda machine. Have you tried that out yet? All right, we'll get you on that here after when we're done. It's a pretty cool little thing. All right, let's just dive into it here. Yeah, we'll get into on-chain lending and borrowing. My name's Tangle, and most of you I know, you new guys, yeah, you'll get to learn a little bit about me afterwards. But yeah, this is a pretty prominent piece of DeFi, or kind of like a crucial, integral piece of all this. So I figured this is a time to go through it, and maybe some people are looking to do some lending and borrowing on-chain as well. But first, we want to get into why lending exists. And I mean, this is all exists because time matters. Capital today is worth more than capital tomorrow. Historically, lending emerged naturally from trade. Farmers needed seeds before harvest, merchants needed goods before sale, and governments needed funding before taxes were collected. Early lending was for personal and for social. You knew the borrower. Risk was managed through relationships, reputation, or by force. Over time, as economies scaled, lending needed abstraction. Institutions emerged to pool capital, assess risk, and enforce repayment. That evolution leads directly to banks. This history matters because crypto lending is not replacing lending itself. It is replacing how trust and enforcement are handled. So if we look back to modern banks, they simply don't just like lend out deposits one-to-one. I'm sure everybody here is like heard of or is familiar with like fractional reserve banking. If not, that's the expansion of like the money and whatnot. So when you deposit your money, the bank doesn't necessarily just like store it in a vault. They use that to they'll deposit it and use it for issuing loans, and being able to keeping only like a fraction of it in their reserves and being able to expand their balance sheet out further. So basically, it's creating new money, and that becomes a deposit somewhere else in the system. And this just expands the money supply and fuels economic growth, which is cool, but it also introduces leverage, and it's at a systemic level sometimes. So it relies on a lot of confidence, and confidence that borrowers are going to repay, and that depositors do not all withdraw at once, aka a bank run. So basically, most traditional loans are they're under collateralized. So if you go to the bank today and you're going to get asked for a loan, there, maybe you're gonna have to put something down, but there's still going to be a whole bunch of the loan that is going to be under collateralized. So definitely some of it can even be like not collateralized at all. They're just saying, hey, we think you're cool. Here's some money, pay us back. A mortgage may be partially collateralized by this home, but consumer loans, corporate loans, and government debt oftentimes rely on income, cash flow, or future productivity. So this works as long as the growth continues and defaults are manageable. The problem is that the under-collateralized systems amplify during downturns or amplify the losses during downturns. So when defaults rise, balance sheets collapse pretty quick. I'm sure there's some people can attest to that from previous things that have happened. But central banks exist largely to stabilize the support through the system through liquidity injections, rate changes, and emergency support. Airdrops. Yeah, helicopter money. Bad debt is unavoidable in credit systems. The question is whether the system can absorb it. The 2008 financial crisis is probably the most obvious example, where mortgage risk was mispriced. Leverage was layered on top of leverage. Risk was hidden inside complex financial products. A lot of it was just garbage and junk. Or the Ninja. Who remembers the Ninja loans? No income, no job, approved. That was really great. When defaults increased, the entire system kind of comes to a freeze. Big takeaway here is that not that lending is necessarily bad. It's just that opacity and leverage and misalignment, can create some fragility within these systems. This lesson also has happened in crypto as well. So that's why we'll get into that a little bit here about how kind of the early stages of crypto lending. It didn't start with DeFi. We had centralized platforms saying, hey, we're going to offer you yield, or we can give you loans and whatnot. So usually it was like in the early days, obviously it was deposited with Bitcoin and ETH. And those were, either to receive interest in return, or we had platforms like BlockFi, if you guys remember that, or Celsius, Ledin, and Nexo. These were all kind of positioned themselves as crypto native banks. Under the hood, these platforms were making discretionary lending decisions, which users had no visibility into. So it's just a big black box. We had no idea how these funds were being used, what collateral existed, and how the balance sheet really was. So it was basically just a trust model similar to the banks, except we didn't have deposit insurance or regulation around any of this. So there was just a lot of problems with all of this, because we've seen too many people just go buck wild when they have the ability to use customer funds. So not your keys, not your coins, pretty standard, and no different here with that. So if we look at some of these market failures here, obviously BlockFi, Celsius, even Voyager, that was another big one too, when we had C and 3AC and those kind of defaults that we had last cycle, where that really imploded everything. We just have we have all this extra counterparty exposure to rehypothecated stuff, loan terms that are mismatched, and liquidity assumptions. They all just break down pretty quick. So the key failure was not necessarily crypto volatility alone. It was just the opacity with the not being able to have the visibility into into these kind of financial products and financial offerings, and them using leverage as well. So users believed they were earning passive yield, but they were basically just unsecured creditors in something that had no transparency. So this really kind of set the stage for DeFi and the need for these kind of protocols, and to just really move away from CeFi, as it were. The transition here to DeFi, some of this is a pretty radical idea that what if code just did it all? What if we remove the human element, right? So if this was always verifiable and you could see how liquidations worked, and if those all happening programmably by code, there's no more negotiations. There's no more human error. There's just execution of code. So this This is where every participant that's playing within the system knows all of the rules before interacting, if they so choose. Some people just go into these protocols and just hope for the best and say, yeah, I know how it works. But this is the beautiful part about all this. If you understand the code, or if you can find somebody who you trust to understand the code, there's a really good way for you to be able to understand the trust assumptions behind it, instead of like, well, where's all my money being lended out or loaned out to, or how is it being used within these systems? So this is kind of like a core breakthrough that DeFi has definitely made possible, and started to make it towards at scale here. So, man, it's also cool because it doesn't require KYC or like permissioned access to things. Whereas if you think about a bank, if you're going to go to a loan, sure, they are just printing money out of thin air and they're just giving it to you and hoping for the best. But that still requires you to like KYC. It requires you to go through the rigmarole of that, and having kind of like white glove service in a lot of ways, which with DeFi, it's come in and get a loan. And if it takes you 30 minutes to get a loan, you've spent way too much time doing that. So, yeah. So if we get at a high level here, DeFi lending just allows users to deposit assets, borrow against them, and earn yield, all without any intermediaries. So most of these systems are over collateralized by design. This is obviously, this is not ideological, but it's like really practical. We don't really have legal enforcement on chain yet. That's, we don't really have anything like that. So code really has to be our, kind of our auditor, and assume that we have bad actors in the system. So different protocols are kind of explored different ways of, how to structure all of their products and whatnot, and how they build their architecture. So, yeah, just trying to aim towards things that it can be decentralized, be able to have interest rates that can be kind of managed differently, and not having to trust people. Let's trust the code and allow this to be permissionless, the way that it was intended, the way Satoshi and Vitalik intended it to be. So, yeah, so basically there's a few different categories here. CDP was kind of like the first kind of way of looking at this, and we'll get into that here, kind of around MakerDAO and whatnot. The other side is pooled liquidity, and that's like most prominently kind of seeing Aave. That is probably the biggest one right now, and the most capital efficient. Then you have isolated markets, which are kind of designed to like really silo risk. There's some problems with that, just as far as kind of capital efficiencies, but it definitely prevents contagion from other debts in the system. And then fixed rate markets. This one we don't see too much anymore, and you kind of see it outside in other, maybe in more like institutional systems. We don't really see it's not as like the matching system, but yeah, it's still another mechanism. We won't really get into it too much today, but each category definitely solves a different problem and has different trade-offs with each of it. So CDPs, like we were saying here, are kind of like the oldest DeFi lending primitive. Users lock up collateral into a vault, and they mint a stable asset against it. The protocol itself becomes the lender. There is no counterparty within this model, and it prioritizes stability and predictability, but requires a lot of collateralization. So not always like the most capital efficient as compared to going to the bank and them giving you way more money than you had it to begin with. So this works really well for like stablecoin issuance, as compared to just like stablecoin, or rather than just like general purpose lending, borrowing. So yeah, basically you're locking into a vault. It's over collateralized, and the protocol gives you the stablecoin. And then there's always like different kind of liquidation mechanics involved as well. We'll get into that. So yeah, here's some of the kind of the notable ones here. So MakerDAO was like the early stage of this, and they were one of the first protocols doing this. They've had some rebrands and some kind of other, now I think it's like called Spark, and you've got Sky. There's the USDS. Is that right? Yeah, USD or SUSD as the as their token. It used to be DAI. That was like everybody was pretty bullish on DAI because it was like, oh, the unstoppable decentralized stablecoin. Turns out there's issues with how that gets all structured and whatnot. But Maker definitely early pioneer in this, in all of this. We have Liquidity. That's an interesting one too because they've just come out with their V2 models and has been pushing it across multiple chains as well with their fork program. This one is kind of designed to be a little more it's like also over collateralized and just has different mechanisms which allow you to set your interest rates and have fixed interest rates with it, and then has like a stability pool to keep the mechanism working and allows for sending some of the protocols revenue to some of the DEX pools as well to help create liquidity. Abracadabra was an old one from a couple cycles ago, or last cycle, now 2 cycles ago, I guess. With Magic Internet Money, their MIM was their stablecoin. There was a lot of looping that happened with that one too. Reflexer and RAI is another. Angle is for an AGEUR, which is more of a Euro stablecoin. And then another notable one was Mai, or from Qidao. That one was like on Polygon a lot, and it was actually one that never really, up until maybe it was a couple of years ago, it was like one of the longest running ones that didn't have any hacks or exploits or something. So it always remained solvent throughout all this stuff. So as small as it was like still pretty mighty and all that. So here we're gonna have a look at this is Spark now and Liquidity, and just having a quick little look at this. But so we can see how you deposit your collateral and you create a stable coin. And there's also like stability pools that can be used to keep the health of the protocol. And interest rates can be fixed or variable depending. But MakerDAO was kind of the first one that introduced this model with DAI early on. So you're depositing ETH and you're opening a vault and you're minting DAI. If the collateral value drops below a certain threshold, that's where liquidations occur, and that happens automatically. It's all through code. So price oracles are the pretty critical piece here, because if the oracle data fails, the whole system falls apart. So that is kind of one of these outside issues, and that's why using a proper, using a solid oracle or having like redundancies in place can be pretty key there. So basically MakerDAO just kind of showed like how decentralized stable credit could exist without like the use of banks. So if we have a look here too, we can see like it's just pretty straightforward too with like you deposit you're going to put 2 ETH in the system, you're going to borrow 2,000 BOLD, which is the stable coin. So if we're looking at Liquidity here just on the left hand side, and then you can see at the bottom there's like an interest rate, and you can see where other people are borrowing, and there's just little tiny ticks. You can't really see it too well here, but if you look at these little ticks, just kind of like right here, that's showing like where people have borrowed. And so the more people that are there, the earliest people are the ones who will get redeemed, and there's a whole redemption process, and you keep the stable coin at peg. A little bit complicated, so we're not going to get too deep into it. I think that's like necessary for a Liquidity V2 breakdown in itself. But there's these kind of new mechanisms allowing stablecoins to keep their peg, because that's a crucial part of this too, right? If stablecoins lose peg, they're designed to be one-to-one with a dollar, and so what can you do to keep those pegs in place? And then when you have your stable coins, you can, with Liquidity, for example, that's another place where you can deposit your stability pools, and that helps with liquidations. So that capital can go in, liquidate a position, and they can receive funds or receive fees from the protocol for doing that. And then just kind of looking at MakerDAO here, Spark, I guess now, where we've got the borrowing, and it kind of gives you your borrowing rate and showing you kind of your LTV. So that's another thing you need to be mindful of, is like if you can borrow, you have an LTV ratio, like a loan to value ratio, and that's like you can't just borrow 100% of what you've deposited, because you immediately get liquidated, because there's none you. If the price goes down a little bit, you have your position is no longer solvent. So they always have like a little bit of a buffer, and here you can see, what is it? I have to zoom in. I can't see, that's pretty small, but think it's like 88% is what they're getting. Usually it's around 90% is where they will kind of have their numbers to keep things, keep it whole. And then you can deposit as well, and then you can earn. So not only is like the side of this for borrowing, but like also just for supplying and lending, because obviously it's a supply, the borrower and a lender market. So that's kind of like the CDP model. And then if we move over towards like pooled liquidity, markets like Compound and Aave introduced a major shift. Compound being this kind of early pioneer in all this. We're not seeing as much with Compound these days. Aave has definitely taken a big, it's the largest by capital right now. So instead of issuing the debt directly, similar to like a CDP, they create these shared pools of liquidity. So that's where all these the supply is getting, the assets collateral is being supplied. So lenders earn on the yield based on utilization, and so we'll get to that in a second here. But borrowers pay the rates based on demand. It's supply and demand, and it creates kind of a utilization ratio. And then, this design scales efficiently, and it supports many assets simultaneously. So it allows for far more capital efficiency within this system, and it allows it to scale because in a traditional sense, and this is kind of where you think about it from like an order book or a matching system, where how do I know that if I have a certain interest rate that I'm willing to accept and having a fixed price or a fixed interest rate with like a certain amount of capital, you have to find a borrower for that to match it, or you have to like put together a couple of these orders in order to make it happen. And in kind of like these new markets where really even at 20 some billion that's being borrowed on like larger protocols, like that's kind of a drop in the bucket compared to like massive lending and borrowing that's happening traditional institutions. So when you get into smaller markets and across different assets, you really need to have ways that you can bootstrap the liquidity, and this is where like pooled collateral has been an interesting model that has allowed it to work really well. If you have tons of liquidity, then you can get into order book stuff. There's probably some other people in the room could do a talk about how order books can be more efficient about in liquidity models, but so some pooled liquidity and some hybrids here too, kind of including a few more. But Compound was kind of like the early pioneer of this model. Aave being the largest kind of by TVL right now. Morpho is another interesting one that's starting to take on. They kind of like tap into other pools as well. Euler has a couple different mechanisms involved, and Fluid is another one that's kind of. It's tying in a bunch more into like the DEX side of it as well, and allowing it to be more efficient with borrowing capital. But anyways, these are all a few that if you are interested, have a look into. We won't get into each protocol independently, but we'll kind of have a look at a couple of them. So here, if we have a look at Aave, we can see a few different things here. So first and foremost, you have to supply. And when you supply it, you're going to supply like ETH to a market. So let's take this example here. What we're kind of looking at is that I have ETH and I want to borrow USDC. So I don't want to sell my ETH. I want to borrow against it. And in this model here, I can deposit some ETH that I have, and so I supply it to the market, and I'm actually getting 1.1 or 1.5% just for supplying, right? And then I look over at if I want to borrow, there's some I can see the current markets for what the rate is here for borrowing on USDC, and what has it got here? That's our health factor, but right now I think in this middle one here, sorry it's a little small for everybody, but I think APU, so the borrowing here I think it's 3.7. I thought it was higher than that, but or 4.8. Oh, borrow. Sorry, yes, 4.8 on the bottom side. So supply info is supplying is 3.7, and borrow is 4.8. So there's always kind of for supplying it gets X amount, borrowing is the other side of it. So there's always a bit of a difference there between the two. So anyways, when you supply the token, so when you're depositing ETH in there, you actually get like an AETH token back. So it's like Aave will provide you like token that's showing you the kind of like is your position. And so you can transfer that around, you can use it, but that's where your position is growing. This, you know, that A ETH is getting 1.5% in interest, and is growing. And then when you borrow with Aave, you're still getting the supply APY. And then, you know, you still, if you're going to borrow, there's still a, you know, like we were saying here on ETH or on USDC, we've got the 4.8 to borrow. So what's I find interesting, and why, you know, when I don't think this is touched on enough personally, is that like how the utilization rate works here. So these interest rates are variable, and people wonder, why does that happen? How does this actually work? Because if you start to gamify the system, there may be like some ways that you can exploit the system and whatnot. But if you look at this chart over on the far side here, it's our interest rate model, and that shows the utilization rate, and currently it's at 86%. And so we see this like chart that looks like a hockey stick. And so the goal here is like in the system, the healthiest way that's the best for borrowers and lenders is to be hitting that utilization rate, or like that target, which is, I think 92% is where they have it here. So what does that mean? That means that 92% of all the supplied assets are being borrowed against. So that creates like a big demand for markets, and it allows for some markets to go, or it allows for more demand, or allows people to borrow more if they want. But now, because of that hockey stick, you see that the percentages get really crazy. So in times of stress or duration, or of duress, or let's say, if you recall when like USDC depegged, who remembers that, like a couple of years ago, people were willing to like pay outrageous amounts to borrow other assets. And I can't remember exactly how that worked, because if you wanted to borrow against your Tether, so then Tether, the USDT was spiking because people were able to lend that out because people wanted to buy Tether. I can't remember exactly how it worked, but at a certain point, these utilization rates increase dramatically because of demand. And when there's so much demand, that's how you, instead of it just being a flat a linear line like this is where it jacks things up, so that it keeps the market kind of healthy and in an equilibrium. And then if it goes down too far, it's just, we don't have the proper utilization within these markets, and they're not as liquid, and it's not as much demand. So that's kind of a look at Aave and the pooled market model. Now we move over towards isolated and risk silo markets. So risk isolation has kind of emerged as a response to contagion, because if you've got if you have volatility within assets in the system, that can become and create contagion within smaller markets. And instead of all of the assets sharing one pool, each market is siloed. So if one asset collapses for some reason, or depegs, or however, it doesn't necessarily like drain. It's not like a massive drain on the entire system. So it definitely improves the safety of each system, but the capital efficiency is just plummets dramatically, because now we have each kind of market gets contained. So some of these, just for kind of notability here, Ajna was one that I thought was kind of interesting when it first kind of came about, because it was allowing for like permissionless markets. So you could literally permissionlessly create your own lending market. Again, there's all these systems in place, or all these mechanisms to make it interesting, but like, where do you get the liquidity from it, and who's actually supplying it, and what are the actual demands for it? So you end up with these very kind of mismatched markets in order to create like really deep liquidity, and so you don't end up with much. But it was a very interesting thing, because anybody could have created their own market with any token. So that was cool. Silo is still around. Again, we'll get into that in a second, and showing just like how much less liquidity there is for certain things. Gearbox was another. It kind of has like some other mechanisms to it. And then I think Euler has an isolated market as well that you can choose. So if we look at Silo here, same kind of things. We see like how we have interest rates curves, and you're borrowing and supplying and whatnot. But if you look here, available in the market, we got 1.2 million, and that's on USDC. So there's not a lot there. and this is one of the most liquid markets that I could find in the system. So this is where you see it just really drops dramatically as you get into these kind of siloed or isolated areas, just because of the capital efficiency. And I mean, sure, at this time of the market too, there's not as much demand for these things. But yeah, regardless, it's cool because you can protect yourself. You know that market is just protected, and it has it's not going to take on contagion from different from different risks. But as you can see here, it's pretty clear that the capital efficiency drops dramatically. So on $1 million that's available, suddenly you're starting to, it's not only I don't need, it doesn't matter, I only need to borrow 200K. Perfect. So this works. Well, but then it also drives up your interest rate curves, right? Because your supply and demand now gets altered. So it doesn't create it does create some inefficiencies and some undesirable effects. So not to say that this stuff can't work. It's just I'm not sure that we've seen anything that's really solid just yet. But if we look at kind of active loans data here, so this is from Token Terminal. We can see kind of some different charts here of over time of these protocols and what's where the capital is and how much is being borrowed. And then here, if we go, this is kind of more of just a better chart here, but you can see Aave is 23 billion in active loans. So you've got quite a lot in compared to Morpho coming up next with 3.7. And Aave, you've got 11 different chains that it's on, so it's spread across a lot of the ecosystem. Morpho, obviously not far behind. Maple Finance is one that I never really got into too deep, but I think that's all institutional stuff now. And I don't know, I remember them having some exploits and some issues and whatnot. So I personally haven't really bothered too deep. Fluid is also interesting. We were kind of talking about because it creates a little more efficiencies within the markets. I think, and I'm not super strong on this, but I think it's similar to I don't know if anybody's heard of boosted pools, where you have in DEX liquidity, it'll use it'll have the borrowed or the borrow or the supplied asset. So it's supplied into Aave, for example. And then it keeps a small proportion of it, 20% or something, that's liquid, but the rest of it is boosted. So because it's sitting inside of an Aave vault or in an Aave vault, so that's always growing. And then as it needs liquidity, it goes in and kind of pulls it out as it needs it in order to keep the pool liquid. So if your swap is going to take more out of it, it's going to sell some, or it's going to withdraw some of the the A token, and then be able to give it back to you. So I think Fluid is doing that a lot more kind of internally is what I think is happening. Don't quote me on it, but it's also kind of it's just an interesting mechanism in that sense. And then we've got Spark, which is MakerDAO has rebranded to Spark and called Sky with their new, and you can upgrade your DAI to SUSD if you want. Camino, that one's on Solana. So if you look here, we have Camino and Jupiter. So those are two others on Solana, that are all still very notable within this. Yeah, and then have several others here as well. But yeah, just to kind of give you an idea of how much is in each protocol and what we've got here. So yeah, so basically there's no perfect lending model throughout all of this. CDPs are obviously stable and can offer really cool backing, but are kind of capital inefficient in a lot of ways. And I don't think we've seen the best model yet. I was really excited about Liquidity V2 and thought that was going to change the game, but it seems like we're still having a bit of a cold start problem there. Pooled markets, they definitely scale, but they can add systemic risk. Right? So we have, if one of these assets that's pooled together that we can use as capital has some sort of risk to it, that can cause problems. Isolated markets definitely improve the safety of all that, but it definitely fragments liquidity and makes it harder, as we kind of saw when you're looking at some of these markets that just don't have the capital that we need. So yeah, fixed, and then we didn't really talk too much about fixed rate markets. I didn't really find too many good examples. I haven't really used much. I remember seeing it for where I did see it recently was more on maybe not smart contract chains. So for example, with Bitcoin, if you're going to go look at like hodl or there's a couple of them, but it's all order book style. So you're trying to match with lenders. And so your interest rates are generally higher because they need to be competitive and they're taking on like smaller amounts. And like I think the biggest amount that I could see was either like, I think it was maybe 30K was like your biggest loan that you could take from one single provider. And it's all a lot more permissioned and it's kind of white glove. And anyways, it gets a little bit complicated. So with, again, as we'd seen, like with these kind of cool mechanisms that are built on chain with things like Aave, and again, just kind of going back to, let me just see if I click back on that. So back here, when we look at that, interest rate model chart where we have like the utilization rate, that helps kind of keep the system in place, and it allows for interest rates to be variable depending on supply and demand, right? So instead of having that, matching order in like an order book that might be really thin, that gives like, if there's not very much liquidity in that system in a fixed rate, it just like creates poor outcomes for lenders, creates poor outcomes for borrowers, and it's just really hard to match that. So just the capital inefficiency just gets kind of cooked there pretty quick. So yeah, that's why I find it pretty fascinating that we're able to do this all with code and keep it variable. Yeah, is this where we were? Yeah. So what else we have? Yeah, basically just, like I said, just more trade-offs, and understanding kind of which ones are more important to you and understanding better approaches on these protocols. Now, one last thing here we want to kind of discuss and touch on here is like oracles, because obviously this all falls apart if we don't have good oracles. So they're definitely like the biggest risk, I would say, well, underestimated risk, let's put it, in DeFi. So every liquidation that's happening, this really requires price feeds and good price feeds. So if these things are manipulated or delayed, and sometimes this can happen in weird kind of illiquid pools, we've seen this happen. Sometimes they can be like liquidated unfairly, or sometimes they're just like not liquidated at all and creates like poor debt or bad debt in the system. So a lot of places are really relying on Chainlink, or like some other similar ones as their Oracle networks. And Oracle design is like really important, just as much as like your lending design. So how that actually interacts and how it pulls in, and if you have redundancies and whatnot. So some of the main, actually we can just kind of get into, we'll get into the certain protocols in the next slide here, but just wanted to touch on like how like the risks are pretty crucial here, where like you have Oracle failure and manipulation, and like your main examples here are like feeds like Chainlink or a variety of others. And then you can have like protocol native Oracle modules as well, which are like the protocol is designed to kind of look at certain parameters and kind of do it that way. And then there's also like time weighted average stuff that happens with with the TWAP, but the time weighted average pricing, that also kind of creates some problems and some manipulations, but sometimes that can be used for some benefits as well. But Oracle's Chainlink obviously is like the household name at this point, I think, for oracles. Pith, also another really big oracle. Redstone, starting to gain more attention. API 3, another feed that's a little bit smaller. I think they're trying to be more of a DAO shape as well. And then you got UMA, which is a different one, which is like an optimistic oracle. So you can provide the system, and it's more like kind of human-based for, to optimistically to give it a challenge. It either decides yes or no accordingly. So that's kind of an interesting model as well. So basically, if we look at all this stuff, we say like, we know that there's risks. Like DeFi lending is not risk-free. There's always risk to these systems. You've got smart contract bugs. Those things like drain you. You can lose your money. This has happened in multiple different places. It's getting a lot better these days with better auditing, lessons that have been learned, better tooling and whatnot. But liquidation cascades, that can also create like crazy volatility within these systems as like positions need to get unwound. and debt gets covered. Over collateralization limits, or that also that limits the capital efficiencies within these markets. So you can't, like we talked about earlier with the bank, where I want to go buy a house. Well, I'm going to take on under collateralized debt as compared to, without or over collateralization. We just won't be able to do the same things. So yeah, these systems definitely trade flexibility for trust, or for trust minimization. So yeah, we got to be careful with our smart contracts. Make sure you trust these oracles and that they're built in place. And make sure and watch over like regulatory concerns too, depending on your jurisdiction. So there might be some issues with that too. So hopefully we don't see any like immutable code getting like shut down, right? Saying, oh, we need to have like these types of protocols that need to actually have regulatory, and if you use them, you're in trouble. Yeah. So what's next here, I guess, for the future direction of DeFi? Yeah, it's definitely a pretty wild space that we're in with all this stuff. The next frontier is credit without over collateralization. I'm not sure how that's going to work, what that's going to look like. I've heard of some new protocols coming along and saying like, well, we'll just KYC you and we'll just figure it out and we'll basically be a bank, but we'll just do it with crypto. I don't know. We'll see how that goes. Credit delegation, reputation systems, and real world assets are kind of hoping to help with this as well. Yeah, we'll see how balancing trust, scalability, and decentralization all kind of work together here. But yeah, we might see more like cross-chain lending as well. Might be some protocols working on that too. Maybe some protocols working on cross-chain stuff. We'll see into being a little more. Yeah. And then yeah, tokenized credit markets. That could be another thing that shows up here too. But yeah, in conclusion here, lending is definitely foundational to any financial system. And crypto didn't really reinvent lending. It just kind of made it better with, well, I shouldn't say better, but it brought different, it enforced different things like transparency and yeah, kind of accountability. So DeFi lending definitely shows that financial infrastructure can exist without centralized trust. And yeah, these systems may not be perfect, but I think the direction is pretty clear that this is the future and we should lean into this when we can. All right, that's all I got for you. There's me and there's my link tree. So, all right, any questions around all of that?
Just something to touch on the under collateralized thing. I've know that there's Wildcat. I don't know if you've looked at them, but they do essentially borrowers KYC, and then they can go after them with legal action. And then I've also heard recently of 3Chain, which I don't know if they do under collateralized, but they basically do off-chain verification that you have some funds, and then they would use legal action too as well. Yeah.
Yeah, I didn't want to get into those too deep because that's kind of like a whole other avenue.
Yeah.
But yeah, I think like 3Chain even has deals with certain exchanges where they can just like, this is mine now. So yeah, I don't know. It's kind of, it takes on different risk assumptions and trade-offs and whatnot. But yeah, there's, I'm happy for the people that try and build that. I just hope it doesn't like create a whole bunch of contagion within our systems, because this stuff is designed to like, we can build these things to protect ourselves, but as soon as we keep taking on these like custodial risks and we take on this like centralized aspect of things and to put more leverage into the system, like this is how things blow up. We've seen it happen time and time again.
So one thing that I am like maybe a bit more structurally curious about, like, I don't necessarily see this replacing all loans, because you have somebody that wants to buy a house that's $2 million and they have a salary of 90,000 or whatever. They can't necessarily over collateralize to buy something like that. So yeah, I'm curious if you have thoughts on that kind of thing.
So to take, like, that stuff won't go away for a long time, I feel, until, well, yeah, I mean, the the fiat system, as we like to call it, is very entrenched and will be here for quite a long time. What I could see happening is when you're starting to say like under collateralized loans, and when we start seeing more of this like on-chain reality, is what we'd really love to see and hope that the world goes towards. One thing that just kind of comes to mind here is really off the cuff, but what you could do is say, I'm going to give my Sabular stream. I can send, like, if that's an NFT, I think some of this can be like NFTs, but basically like your stream of your yearly salary, for example. If that's like, let's say you've got a $100,000 stream that's coming in there. That's your annual salary. You could give that to the bank and say, there isn't $100,000 in here right now, but at least you have the promise. You can see that there is the potential for $100,000 to be streamed to you and is coming from my employer, and they can make that assumption, right? So now we know that there's something on chain instead of just trust me, bro. It's like, well, no, there is actually something there. There is $100,000 locked up in that contract that is being streamed to me. And as long as I'm a good actor and a participant within my, for my employer, I will continue to receive those funds, and those funds go directly, because my participation will ensure that the employer doesn't pull the funds out of that stream, and that can, be given to the bank, and then they can have claim on that and control, and they can, pull it out as they want. So I can see things like that, but again, that's a long ways in the future. Like, how many people here have actually been paid in a stream, like a Sabular stream or a Superfluid or a... Two. We have 2 people and only once. Okay. Anyways, that'll be maybe another talk sometime about streaming and how that can all work. But anyway, that's how I could see that could work, where you have like the promise of capital that is verified on chain or something. That could help. But as far as like traditional loans, like this is where we're going to see banks coming in and saying, all right, we'll take your, your digital assets as collateral. They're going to take it. They're going to go do all the Ponzi's that they've done in the past with it, and they just create more money with it that way. So they're going to take on these assets that they just no different than like just different collateral assets that they're going to say, okay, put your car as collateral, you put your house as collateral, we'll give you more money. Same kind of thing. It's just now we're doing this weird loop of going from DeFi back to CeFi and going back to traditional stuff. So then we start taking on those kind of risks, and we're just praying that, trust me, bro, the banks aren't gonna, they're not gonna be incompetent with their lending and borrowing, which seems like it just doesn't really stop. But I don't blame them, grab a mic.
I just have a question about what kind of loans are people taking out to do with these type of protocols at this stage?
This current stage in the market,
because people aren't buying cars or houses with them, right? So what
maybe
are
they
they
are.
doing?
I don't know. Maybe they're using it just for like daily expenses, and just saying, hey, I'm still bullish on this asset and I don't want to sell it, right? Because that's the other thing is now, and one thing I didn't really touch on here, which I should have, but it's kind of a mixed bag, I guess, is even just your tax obligations. So depending on your jurisdiction, it's different everywhere. But like, if you sell your assets, you might be at a loss, and that might be fine. But let's say you bought ETH at $100, and now you saw it go to like almost 5K, and now we're back down to $3,000. And you're like, wait a sec, I don't really want to sell here because I still have to pay. I have a huge tax obligation, but I'm still bullish on ETH. I still think this is a $5,000, $6,000, $10,000 asset, right? Or that's your time span, is that I'm willing to hold this till $10,000. Regardless, not financial advice with any of this stuff here, of course, but if that's your thesis, you might say, you know what, I want to hang on to this asset. I don't want to like pay the taxable obligation for me to sell at $3,000 on a $100 purchase, because there's tax that has to be incurred there. So you might say, you know what, I'm going to borrow against it because I need $1,000 right now. I really need that $1,000, or $1,000 per ETH, or however you want to look at it. And then you're just paying an interest rate and saying, hey, you know what? This keeps me from liquidating, and it allows me to stay solvent. Away we go, and you feel like the interest rate is worth it for you in order to retain your asset. So. Yeah, or just if you're just like, hey, I'm just going to borrow against it forever. There's probably, at a certain point where you're just like, okay, if you bought, you know, if you bought ETH at $100 and now it's $3,000 and, you know, you've got 1,000 ETH, you might say, well, it's okay for me to take out an LTV at 10% and I'm just going to live off that now, right? And you can just keep rolling that, or just keeping it going, or keep rolling on. And as the price goes up, you could take out more against it. And anyways, there's different strategies that you can do with that. So not financial advice in any of this, but yeah. And maybe there are people that are borrowing against to buy more assets, right? So you have ETH, borrow against to get your, you know, buy some sort of stable, and then, or to borrow some sort of stable, take that back in, you're going to buy more ETH, and, or buy more whatever you're bullish on, buy more Bitcoin, buy more Solana, whatever it is that you're bullish on, right? And then maybe you're going to take that asset again and borrow against it, and then it'll go out again and buy some more. Anyways, that's the whole looping and the multiply situation, but that also creates other risks. So yeah, careful.
How do you pay the interest?
How do you pay it? You're either, hopefully you have a job that you can fund that with, or yeah, are you meaning just like how do you cover that, or do
Yeah,
you mean how does it
exactly.
work in system?
Yeah, in the system. Let's say I don't know anything.
Sure.
Okay. Which is true.
Yeah. Okay. Yeah. So I guess I didn't really touch on that too much here either. Is that the interest is just accruing? So it's like in order for you to receive to like return your assets, you will have to. There'll be, if you originally borrowed $1,000, let's say, and you're borrowing at 5%, and it's stated around an average of 5% over the year, you now owe $1,050, right? So you have to come up with that $50 from somewhere else, right? So that's either you're selling some other asset or whatever else, but you need to repay that $1,050 in order to unlock your capital. So that's where, yeah, however you come up with that 50, you can. Yeah, that's the simple answer there. Anyway, so it's just like it's constantly accruing, but you need to keep that in mind too, because you could say, oh, I'll just let this go forever, and potentially could, but at a certain point, like depending on how much you owe and what the liquidation prices are, and if you just like keep that interest forever, eventually your debt in the system hits is going too high, and will then cause like your liquidation price because your LTV is reaching too high, right? So obviously that's depending on, you know, those kind of interest rates and whatnot. That does create a little differentiation. But
Is there a way such that the interest you're earning compensate for the interest?
So now you're kind of getting into like these kind of weird mechanisms where like, okay, so let's say if you're supplying ETH. So where were we here? Back in, let me go back to here, right? No, it wasn't here. It was here. So you're supplying ETH and you're getting 1.5%, and then you're borrowing at 4.8, right? So you're paying, depending on like, because like those are two uncorrelated assets, right? So they're not the same. So you're hoping that like ETH is really pumping, and that nobody is saying that the rate is going to increase for borrowing. Because if ETH is pumping, then it's like, wait, I'm making, you know, if it doubles in price, it's basically the same amount of value that you were getting in dollar value at 1.5 has kind of turned into 3% if the price of ETH doubles in this instant, right? However, if that's happening, people are probably saying, you know what, I'm willing to borrow more USD, or borrow more USDC, so I'm willing to pay more for it. Because I literally just watched a massive increase, and maybe I watched even a 5% jump today, and I'll happily pay 5% over the year to try and have that exposure to that price over the next day, right? And then even unwind the position from there. But it starts creating these kind of supply and demand mechanisms. So there's, again, this is where you have to like game it out, and things are, how you want to like handle that. But generally those inefficiencies of like, oh, we can supply more and I can make more from borrowing, or like the kind of spread is positive. Like unless if you're there's a way to maybe do it with like supplying more, so it's like you're getting more interest from supplying a whole lot more, but you're borrowing a really small amount, so that the actual debt of it is, and the interest is lower nominally than the supply that you're getting, and so maybe there's some sort of win there. But Yeah, I don't know. You'll have to look at that's like we're starting to get into like sophisticated actor things. So yeah. Anyway. Yeah.
Where does the term oracles come from in this context? And does Larry Ellison approve?
Sorry, Larry Ellison?
Yeah.
I'm not
approve.
familiar. Is that who made Oracle? He's the Oracle?
Yeah.
Is the Oracle like the company Oracle?
The company.
Well, but Oracle is an old word, and he stole the old word.
Yeah.
So
why is the term oracles used in this context? It doesn't seem intuitive to me. Maybe I'm missing something.
well, I don't know. It kind of is. Like the Oracle has to tell you the price. Maybe here.
Well, yeah, like the oracle is telling you the truth, right? Like that's historically, or that's what that's what an oracle is somebody who tells the truth or a source of truth, right? So this is essentially a price source of truth that's put on chain. So people can check what the oracle is saying the price is, if that makes sense.
Do you want to answer? Go ahead.
Okay, this is my interpretation, but in the ancient world, the oracles were these these young girls that they couldn't do much of anything else, but they had a psychic link, to another realm, right? So the Greeks believe that there's this other realm called like the Logos, and that is actually the real world, and we're in some kind of less perfect, cloudy world, right? And so we have to use these psychic girls to reach out and get like our fate and like all this other information from, the real realm. And the metaphor is that on a blockchain, everything that happens, it's like a closed system and it's deterministic. So like there has to be, there can't be outside perturbations, right? So you have to trust something that's piping in outside information that breaks the determinism, because like we can't predict from one tick, like one like internal clock to the next, what the price of something is going to be. So we're relying on like a trusted psychic to like tell us the truth about like, hey, in the real world, what is this stable coin? That's actually a good example, because the stable coin has to float around, right? Like, and float around some kind of peg. So we want to know in the real world, what are they like selling dollars for? Because we need to use that in our system so that we can price things effectively. So it's a way of like taking like there's the real realm and we're piping it into the contrived toy model realm, and that's why it's called an oracle.
Beautiful. Yeah, snaps.
So in institution, no realm of DeFi and crypto, Aave is starting to around the longest, has the most scale. Aave's great. Institutions love it. Real world loves it. In the case where like, let's just say that Aave does get adopted by all these institutions, what is the point of these other types of protocols, other types of categories of borrow lending protocols if Aave has already won, essentially?
Well, I mean, that's why they go with that motto. It says just use Aave. So they're really trying to lean into that, because they say, oh, why would I do this? Why would I do that? So they do have that kind of mindset already that they've, and I mean, you look at the TVL, it's like, yeah, I mean, pretty wild. But yeah, there might just be trust assumptions that people just don't want. Like there's people that just say, hey, I won't hold a a censorable stablecoin, right? They're only holding DAI or now Sky USD or whatever.
I can still borrow DAI on Aave, right?
Yeah, you can. Yeah, of course.
So
but I'm just saying as like a more of a.
I guess specifically like all these different why have Liquidity? Why have Euler?
Yeah.
Aave.
Yeah, I mean, again, just different trade-offs, different models that people might feel more comfortable with. I was just using like stable coins as a totally different example, not necessarily within the system. Liquidity, for example, that is designed to be, it's supposed to create a stable coin that is immutable and unstoppable, right? You can't censor that. Whereas like USDC or USDT, even if you borrowed that out of the system, it can like Circle or Tether can say, we're freezing those coins, right? And those are frozen and you're hooped. Whereas something like Liquidity, Bold and LUSD are uncensored. You can do whatever you want with them. They can go in anywhere. They can't be frozen, and you can't just like shut the protocol down either or change it. There's no like governance to it. It's like immutable code. Away you go. So it's a beautiful system. Want it to work. It just needs to scale a little bit better and get adoption, but there's no utility for it necessarily, and there's probably not enough. Anyways, there's a whole mechanism around the liquidity pools and the protocol incentivized liquidity and stability pools, and anyways, a lot of levers that need to get pulled. So people might want it for that, right? That's why they would opt into those systems. Once we get into other places too, it's just maybe they can be more capital efficient, or maybe just like competition is good, right? It's just like, why would people drive a certain vehicle instead of other things, right? It's just that's other options. But you are right when it comes to a capital efficiency model. If that's your main goal, is like, how do I get the cheapest loan, the cheapest and safest loan? Probably going to go to the bigger places, but competition's probably good too.
I think a lot of that has to do with risk as well. So if you look at Aave is like a monolithic protocol, so it has a lot of exposure to a lot of different assets. And someone might not want to integrate Aave into their product and use a different curator, for example. So the Aave DAO controls the kink of that curve, essentially, and they control how interest rates work. Now, if it takes 3 to 4 days for a proposal to go through, that's a lot of risk. Let's say an asset depegs. The question, I think, a lot of why do these other ones exist is just a lot around risk as well. So risk, you have these isolated protocols like Morpho or Euler kind of has these elements as well. And you can do different things, and you can have different curators kind of control these knobs for you. Versus having Aave DAO do that as well. So I think those are some of the trade-offs that we kind of see in the space.
Yeah, that's a good point too, with risk. And if you look at like Aave, what assets it can take in as well, right? Like if we want to have new other assets or going out the risk curve a little bit further, which maybe considered, these assets may be considered like safe or acceptable across multiple places, but you just need those protocols to be able to take that risk on and have the ability. And you say like with governance too, there can be like governance aspects to things too. Like there's some people that don't like the governance aspect around Aave, right? Or different. Everybody has just different trade-offs, right? Some people like things differently. So risk, good point, risk. And then even like with the on the permissionless aspect, like I say, why would you use Ajna, for example, or like these super isolated things? Well, permissionless. Hey, you know what? I'm willing to supply my protocol token that may not have any liquidity or real desire or drive or really demand for, but you know what? If people want to borrow against it, I can create a permissionless market for it, and people can come in and supply assets, and there can be a market, and we can do that, and I don't have to go to Aave and try and get a proposal passed and go through governance and convince a bunch of people that no, the Tangle coin, it's really, this is it, this is the future. Whereas I can just go and create that permissionless market myself, right? So I think, just other options to allow for functionality and composability too. All right. Any other last questions? All right. Okay. Well, if not, thank you everybody for coming out, and thanks for everybody online that has popped in. Please stick around for a little bit if you want. You can fold up your chairs and hang out. And we've got planning to migrate to the next space. So we've got a few documents that are kind of circulating here. We've got a Notion doc kind of giving out a bit of a vision of what we plan to do with the space and what we want to try and do and what we're kind of hoping for. So a lot of ideas about the next space. We're going to put out some surveys as well coming soon, just to get feedback from people on exactly what they would want, kind of regarding co-working and whatnot, and maybe different locations in the space or in the city. And we've got a donation page up on Giveth. If anybody's feeling charitable, we're on Giveth, and we now just got signed up on Geyser, worth mentioning as well. So for anybody here unfamiliar, Geyser is kind of the donation platform on Bitcoin, and you can donate through Lightning as well. So you're on there, look for Decontrol on either one of them, DCTRL. Yeah, and you can donate there as well. We probably should have been shilling that way sooner, but we do have it on the bottom of our live stream, but it's kind of blended in there a little bit. But all right, with that, everybody.